This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, as always, and today we are very pleased to welcome on an interesting guest, Kevin Carter of EMQQ Global. Kevin's backstory is fascinating. We have a lot of cool and interesting guests, and sometimes the CV and the resume of our guests is a little bit longer than others, and Kevin certainly fits that bill of the latter. So we're excited to have him on today. We're going to be talking about looking outside kind of our borders of the United States into markets that might have value that can be achieved with investing in different places around the world, such as places like India, China, Japan, and how some of those kind of cross-pollinate onto our markets as well. With that said, Kevin, I'll let you kind of give your intro. Really happy to have you on with us today. Thanks for joining.
Sure. Thank you for having me. Well, I'm the founder of EMQQ Global, and we are focused on emerging markets, and in particular the internet companies in emerging markets. So the Amazon.com of Brazil or the DoorDash of India, for examples. I mean, these are the local versions of the types of things we have here. And so that's what I do now. But I started in the investment business here in San Francisco in 1992. I started at what was the leading technology investment bank at the time. And so I had one interview actually, and we talked about college basketball. And then the guy said, "You can start Monday." And I said, "I don't know anything." And he said, "Go buy this book." And he wrote down A Random Walk Down Wall Street, which is a pretty well-known investment book that's, I think required reading in a lot of business schools. And the reason it's well-known is when A Random Walk was first written in 1973, there were no index funds. There was no such thing. But the author, in the first edition of A Random Walk, he said, "I have an idea for a new type of investment fund that somebody should make. And it's a fund that owns all the stocks. It doesn't charge a big fee." So I read that book about indexing in efficient markets, but then I, quickly gravitated towards Omaha and Warren Buffett and Charlie Munger. So I'm more of an Omaha person, but I've ended up being business partners with the man that wrote A Random Walk Down Wall Street, who's a Princeton economist named Burt Malkiel, for the last 25 years. So I've been sort of entrepreneurial, and I started in 1999 the first online brokerage firm that traded in dollar amounts instead of share amounts, so fractional shares, which was acquired by E-Trade in the year 2000. And then Bert and I started working on what's now called direct indexing, which is personal. Vanguard calls it personal indexing, but build your own index, if you will. And then that company we sold to a Boston company in 2004. But right before that, Google went public, and they asked my partner to talk about investing. And then a few guys from Google called me and said they wanted to make their own custom index. So in 2004 and 5, I was going back and forth to Mountain View and doing this direct indexing for these Google people. And my partner Burton started going to China. Two of his Princeton economist friends were Chinese economists, and they convinced him to go to China and see what was happening. And that resulted in a white paper. And the Google people called me and said, "Hey, can Burton come talk about China?" And I said, "Sure." And little did I know 20 years ago when I drove down to Google from San Francisco that after Burton's China talk, all of these people would look at me and say they wanted to invest in China. And from the moment that talk ended until today, that's not planned, but that's what I've been doing for the last 20 years, is trying to figure out, okay, how in the world do you invest in China and then in this emerging market category more broadly?
Yeah, absolutely. The concept of investing in China is something I find fascinating for what I get to see. And again, I don't see too much of it come across my desk for what my clients do. But anytime I get to talk to someone, even tangentially, about how it works, it's always fascinating when you look at markets and just in general cultures that are so kind of on the other end of the spectrum from ours. And there certainly are corollaries between the two, culturally and investment wise, but it's just anytime you get to look at something that is wholly a different book, if you will. It's always fascinating. But again, not the core topic of what we're talking about today. But thank you very much. Your resume is fascinating, and I always enjoy getting to speak with people that have such large amounts of experience in these things. So, one thing that you kind of alluded to again on the front end of this is emerging markets, and I think people generally kind of understand, what that is. Especially when it comes to hearing the news of saying, hey, this thing's coming out of X, Y, or Z country. And a lot of time we hear things, about countries, like maybe Brazil or, India with, these huge markets and marketplaces that are continuing to grow. But what people don't realize is the companies that we're so used to seeing in the United States, right? People like Meta and your Amazons and, again, all these different kind of companies that you assume are just global, right? Why would there need to be a kind of a local version of, Facebook somewhere? But there really is. And the ability to kind of find and derive value in these different places is pretty interesting. So, from that perspective, let's kind of let's pick on India for a second.
Sure.
When it comes to looking at that market as a whole as emerging, what are some interesting things that you're seeing, at least currently right now, that are interesting propositions for the investor? Just again, starting to kind of look outside of our borders, and what they may not realize is kind of more of a ground up or start kind of more of a burgeoning market than here in the United States, where we have something that's very mature.
Well, first, what I would say in terms of emerging markets, let me first lay out what exactly are emerging markets. So basically, the general idea is these are countries that have low GDPs per capita. They might have GDPs per person of 2,000, 5,000, 10,000. To be developed, you need 25,000. So anything below $25,000 a year per capita is considered an emerging market.
And just real quick, so people kind of understand what's currently right now, what's the US's GDP per capita?
Oh, 60,000, 50, 60,000.
Okay, cool. Just so, because again, I didn't know that number, just so people have an idea. So back to kind of the definition.
So basically it's the lower income countries and they're emerging. And what happens is the process of emerging, it starts where you have a half an acre of land and some crops and a pig and a cow and I have the same thing, and then you get specialization. Well, I just grow pigs and you just grow cows, and then we meet at the market and we trade our stuff. You get infrastructure investment, you get more specialization, you get manufacturing development, and you move on up the development ladder. And so, but geographically, if you wanted to look on a map, where are emerging markets? It's about 60% Asia. And when I say 60%, I mean the population, I mean the GDP size, I mean the stock market. About 60% of emerging markets is Asia, with China and India being the biggest parts of that. It's about 15% South America, Brazil and Mexico, most of that. And then it's Africa, it's Eastern Europe, it's Kazakhstan. And so it's kind of all over the place. And it's not really homogenous. I mean, all these places are different. Some of them have, GDPs per capita of $3,000. Some have $12,000. Some of them are, like China, very homogenous, where, most of the population is the same race. You have places like India, where there's 24 official languages. So there's nothing homogenous about them. But and when you really break it down, the case for emerging markets is that they're big. They have most of the world's people, 85% of the world's population. They're younger, so they have better demographics. Their economies are growing faster, and that's driving consumption. And it's the consumption story that is the big story. The thing that's actually emerging are 6.5 billion people, and they want more food, better clothing. They want heaters and air conditioners. They want to be entertained. They want to go to a movie. They want to get on an airplane, buy a $19 plane ticket and get on the first airplane ride. And they want their kids to go to Harvard, and they want a car. Mm-hmm. And so that's really what it's all about. And so if you're going to invest in emerging markets, that's, I think, what you should focus on, is that rise of the consumer. And that's what I've been focused on for 20 years. But 11 years ago, when this device showed up, I realized that, that just as in our own world, that maybe it wasn't the Sears you wanted to invest in. Maybe or the J.C. Penney's. Maybe you wanted to invest in the Amazon of Brazil and not the Sears of Brazil. So that's really the reason I started this company.
Yeah, and I think what people a lot of times don't realize is that we get so, and again, the core market, the core audience for this is people in the United States, right? We get so kind of blinded to the maturity of all the things that we like, right? The fact that we do have that cheap plane ticket, you can hop on a JetBlue or a Spirit, or you have Delta, you have all these options for these things that you would assume just are inherent that, okay, hey, maybe they have more money and they're automatically going to have that. Well, there's a lot of homegrown aspects to these emerging markets, right? Just because we have Amazon here doesn't mean that Bangladesh, India has the exact same thing. They don't necessarily have the Facebook, even though it's on the internet, right? It's this ethereal thing that, hey, they have the internet in India and China. China's is definitely considerably more restrictive from that aspect. But again, looking at India for a second, you would just assume that saying, hey, okay, once they have a certain amount of GDP, then yeah, Amazon is just going to do it, or Facebook is just going to be there. But that's not the case. So when you kind of look at, and I like that analogy of saying, hey, now we have this, and then we, okay, we have more of this. Now we want to, increase our trade and our consumption, right? It's that consumption factor that we're looking at. Where are kind of the things that people typically gravitate towards, and maybe what are some of the reasons that you don't see just this automatic kind of, again, from the consumption aspect that, these big US based companies just go in and consume these markets, right?
Well, they actually have in some places. And this is where it's also, it varies from region to region. So, for example, starting in Latin, I'll start, south of our border here in Latin America. Latin America's e-commerce leader by far is a company called Mercado Libre. MELI on the NASDAQ, and it's the Amazon.com of Brazil. Now, its headquarters are in Uruguay. So if you look in the database, you'll say, oh, it's in Uruguay, which is a small country, but that's just where their corporate offices are. The revenue comes from Brazil, comes from Mexico, comes from Chile, Bolivia. Every Latin American country is on Mercado Libre. And so because Amazon was late to get there. Amazon has tried to, gain market share, but they've been largely unsuccessful so far because Mercado Libre, was basically started in 1999. And it was actually the Mercado Libre founders wrote the business plan at Stanford in the library because they were, they're Latin American kids, but they went to get their MBAs at Stanford and they wrote the business plan at the library there before they went back and started this company. So, so in South America, Mercado Libre wins. And the other thing I would say, because I'll describe it as the Amazon.com of Brazil, but the reality is you can't call Amazon the Mercado Libre of anything. And here's why. A lot of these companies started, like Mercado Libre in Latin America, nobody had a credit card or any digital form of payment. And so the delivery drivers were getting paid with cash and making change. And as you can imagine, that's got a whole lot of challenges tied to it. It's dangerous and clumsy and whatever else. And so Mercado Libre started a payments platform called Mercado Pago just to facilitate payments. Well, guess what? That business now is more valuable perhaps than the e-commerce business, because once you get the money on the phone, then you can become the bank and the brokerage firm, right? And so imagine if you had your brokerage account at Amazon and you bought your ETFs and even your crypto at Amazon. That's what Mercado, it is the e-commerce leader, but it's also the bank now in Latin America. So now in China, of course, some of the U.S. tech companies were there, but China had its own homegrown, and for obvious reasons, the local competitors have an advantage just by the fact that they're local and and the language is different than in the U.S. And they were also very early. Now Google was in China, but they made largely a political decision, the management team, to leave China, and so they were there. So China's internet is dominated by homegrown companies. Tesla isn't an e-commerce company, but it is a pretty successful U.S. business. and as is Apple. Making and a lot of Chinese people have iPhones. So now India is a pretty special situation. Facebook and Meta and Google are both there. And I should also mention Meta is also in Latin America. So Instagram and Facebook are those platforms have really gone global. WhatsApp certainly as well. Now on the e-commerce side in India, you have two leaders. One is the local version, Flipkart with a K. It has the largest market share, but Amazon's number two in traditional e-commerce in India. So it varies by country. It varies in a lot of ways, but the U.S. platforms, the FANG stocks, they certainly have market share in some of these emerging markets.
Sure. And would you say that it's kind of a fair assumption? I mean, when looking at the emerging markets, just like we in the United States, I mean, there's a national pride. It's like, hey, I like driving a Ford because it's made in America. I mean, personally, I drive basically all Toyotas because I like my stuff to last 300,000 miles. But there's that sentiment, right? Of liking that kind of homegrown aspect of what you're consuming, right? And not to, discount kind of that first to market, kind of like Mercado Libre, building out this whole ecosystem of, between payments and logistics. Is it kind of another thing that can drive value on looking at investing in these markets of saying, hey, look, if they have a competitor that has and is gaining market share, that there's some stickiness to it from the inherent kind of national pride that almost any country is going to have towards the more homegrown option as opposed to the multinational conglomerate coming in from the United States or abroad.
Well, here again, it varies greatly. I'm processing some specific examples in my head. So let me first say, at the high end, the European luxury brands, the Louis Vuittons, they don't have that much homegrown competition. There are certainly brands in these countries that aspire to be the local version, but it's hard to achieve that, right?
Yeah.
They're aspirational brands. They already have this cachet. In China, Nike is the Nike of China, right? But there's several other, the Reebok and Converse of China are Chinese brands. So, the two of the leading Chinese brands are Li Ning and Peak Sports, also Anta, and. But Nike remains at the top. But then when you have, again, nationalist moments, when, especially if there's government tension, and I know certainly between the United States and China, there's been a lot of confrontation over the last decade. And that certainly has impacted the way the Chinese look at their own brands. And so there is that sort of nationalist pride, but that only goes so far, right? If Nike's still I'm looking at your shirt there, the swoosh is a powerful thing. In fact, that was, my first real experience with the power of this in 1997. After I got married, my wife and I took several months and traveled through South America and Africa. And I had several pieces of Nike gear. My shoes were Nike. My hat I had a Nike hat. Every single day, somebody asked me about, every day someone commented and said, oh, I like your Nike. And people, the porters or whoever else we had, spent time with, they were all begging me for my hat or my shoes or whatever. Slowly I gave away all my Nike stuff, but it was pretty clear that brand in particular had global, appeal. Now in India, they certainly have a lot of their local brands. Consumer brands for food and clothing. But they also have a lot of the consumer products are owned by Unilever.
Yeah.
Now they might be localized brands, but it's the European consumer products company Unilever that's going to have most of the day-to-day, consumer goods.
Yeah, and I would say that from what you're kind of saying, though, it seems like that there's a little bit of a difference, right? There's the kind of consumer product portion, right? Your Nikes, your kind of Unilevers and stuff like that, where there's a little bit less of a inclination for there to be the kind of homegrown aspect, right? You might be able to look and say at these emerging markets, say, hey, like this emerging market might do well to drive value in, let's say, Nike, right? Like if there's all of a sudden a huge growth of wages and consumption at a place like India or again South America or again to your point Africa as well, that these companies might do very well. But tooling up a homegrown option is for like the manufacturing of anything is tough, right? And we see that across any industry. To put in the infrastructure to build and actually create a durable, or again, I'm going to call sure a durable good, but in the general concept, something that you can actually pick up and touch is tougher. When you kind of look at the tech play, I think kind of from what you're saying, it's a little bit easier to find those early stage companies to invest in that can really have that kind of more meteoric growth, right?
Sure. Well, that's one of the beauties of these internet businesses is they can scale quickly. They don't need to build new factories, right? They have the app, and the app just needs more people to download it. So this is, as an Omaha person, one of the most important words in investing is a moat, right? What is your competitive advantage? What's the river with crocodiles around your castle that keeps your competitors from coming for your treasure? And historically that meant a brand just like the swoosh, right, or the Coca-Cola brand, or that those were the best moats, in Omaha world. But now with this technology, there's new moats, and one of them is the network effect, right? You and I could start a social network tomorrow pretty easily, but if there's nobody on it, it doesn't have any value. So
not very sociable.
that's right. So yes, scaling up those kind of businesses is a whole lot easier. Having said that, Apple's making hardware in China, and Tesla went in, when everyone else said China was uninvestable, Tesla went in with real hard dollars and built a mega factory and is, executing one of the most difficult businesses in the world, which is to manufacture automobiles. So, yeah. And it can't scale the way a new hot app can, but to your point, it's a much more challenging, and because of that, it doesn't happen as often as some other things do.
And one interesting thing, at least from kind of some personal experience I have with friends and peers, I should say, because not necessarily colleagues at my firm that I work for, is that when we look at the emerging markets from the United States perspective, especially, and I'm going to look at tech, right? A lot of it was like, hey, what's going to be that flash in the pan? What's going to be that first one that really just kind of takes off, right? You have your Google for search engines. I mean, you had AltaVista, you had some other ones that kind of came before it, but then you have the one that really kind of gets it and launches. Then you have like in your Amazons, you have your Facebooks and stuff like, it's hard to kind of say like which one's going to really hit. But when you look back on it, you can say, okay, here's some data points that we can look at and say, okay, going forward, what might, you can you can scale that knowledge and that analysis of, hey, like, here's what we look at, here's what might going to work in that market, and we have the data to look at that. And the interesting thing for the emerging markets is that now we have that kind of that historical lens to look for. Okay, look, here's how this kind of stuff worked and built in the United States, and when we have an emerging market, here's some things that we can look at, that might be a driver for new things. An interesting example is I have, a friend that's a web dev and also does app development, and he and a colleague are developing some apps for the Brazilian market, and they were kind of testing a few things. They're more in the game space, but they found out that the one game that they're soft launching has basically kind of turned into is being utilized more like the app grinder in Brazil, which is an interesting concept. But they're like, this is really interesting. Like, this is the consumption and how this thing's being used, and otherwise of not understanding, like, hey, these kind of things, like, here's the things that they're missing, and then you can kind of tailor things to work really well in a market like that. So from that perspective of that lens of historical understanding of these things, is that really something that is working well in these markets to say, hey, look, like, especially for India, they have these other things that you can look at and say, okay, what's going to be the next Facebook? Like, is it going to be homegrown, or has Facebook learned those lessons and there's not much of a competitive advantage for the internet side of things?
Well, I think that let me tell you what's going on, because at a high level of what you're talking about. So, the reason I started my company, was for the first 10 years I was involved with emerging markets. I told people, just buy the consumer stocks, just buy the food and clothing companies, right? And then the smartphone showed up. And what I realized was that, Mercado Libre was the best emerging markets consumer company, but it wasn't called the consumer company. It was called a technology company. And so if you bought an emerging market consumer ETF, you got the food and clothing companies and the Walmart of Mexico and so forth. But maybe you don't want the Walmart, maybe you want the Amazon, right? And so that was kind of the light bulb moment. But here's what's happening in emerging markets. And it doesn't matter if you're looking to invest in China or Brazil or Southeast Asia or India. It's pretty clear what's happening because we did it, right? But it basically goes like this. You've got all these new consumers in emerging markets. Now, we've been consumers for generations, so we don't think about that as a trend, but that's a trend. Now, we've had computers for 30 years. Well, guess what? All of these people in emerging markets are getting their first computer today. And it's not a desktop computer. And it's not an Apple computer. It's an Android-based smartphone that's getting better and cheaper every year. You can now get a brand new smartphone in India for $12. Brand new. And the third trend that's sweeping the planet is called the internet. I got the internet in 1995 on a telephone line in San Francisco with a modem.
Yep.
Obviously, it's gotten better and faster. Well, guess what? Nobody had telephone lines, let alone high-speed cable. So you've got billions of people getting their first computer and their first internet. And what makes this whole thing, because we've just lived this, we've seen the FANG stocks take over our lives and our stock market. What makes this even bigger in emerging markets is everything we have is evolutionary. We had PCs, then laptops, we had telephone internet connection, then Wi-Fi, then, on airplanes. These people are going from 0 to 100. They never had a bank account, most importantly, right? They all of their entire financial life is paper-based. And so when they get this first magic device, this pocket-sized supercomputer and high-speed internet, they are getting all of these things, and they're leapfrogging all the steps we have taken. And it's created what is not just the fastest growth in emerging markets, but probably the fastest growth in the world over the last 10 years. But most of that growth so far has been in China. So, China might be an emerging market, but when it comes to the internet, it's now the most developed country in the world. And their e-commerce market is bigger than all of the other emerging markets combined times 4. So what the next 20 years is going to be is the same story going to India. So what I've been focused on, and I think that, listeners should think about, is the Indian internet and what it's going to do in the next 20 years, because it's really just getting started. And so the third internet wave, the first wave, people like you and me in the U.S., starting in 2000, the FANG stocks took over our lives and our stock market, first on PCs, then on smartphones. The second wave was China, right behind us. And now we have Alibaba and Tencent and all these Chinese giants. Well, the third wave is everyone else. That's Brazil, it's Indonesia, it's Korea, and it's India. And India is bigger than all of those other emerging markets combined if you leave out China. So India is very special, and we have an EMQQ strategy. So, we invest in all emerging markets, internet companies, but we have one that's just one of our strategies just focused on India and the India, the FANG stocks of India, if you will, which is EMQQ. And that is, I think, where, if I was a young person and I had a 30-year time frame, I would definitely be thinking about buying and holding exposure to the Indian internet sector for the next 20 years.
No, yeah, and that's such a cool concept because again, just to kind of come back to the simplicity of everyone's like, hey, I really wish I could have invested in, X, Y, or Z American company at the very beginning of their growth cycle. Well, you have that option. You just have to kind of look outside of your front door. The front door is just a lot larger, and there's a Pacific Ocean between us. But it's that kind of concept of just broadening your investing horizons. Now, I think a lot of people, and again, I think it's good to transition a little bit from the basis of, hey, like, what are emerging markets? Why are these things a thing, right? And we've gotten that basis, but now it's all well and good to understand that, but how does someone kind of go about investing in it? And there are certainly, I think people understand that there's foreign companies listed on the U.S. stock exchange, right? There's companies that are again listed here that are again in these emerging markets. But again, I think those are a little bit more closely examined. And when it comes to really getting involved in some of these markets, what are some ways that people can really do it? Do you have to go directly to these exchanges? Are there indexed funds that can kind of track these on a more individual level where you don't have to kind of day trade the Indian stock market and be up all weird hours of the night? How do kind of people look to get exposure to this from the investment standpoint?
Sure. Well, there are a lot of emerging market internet companies that trade in the United States, Mercado Libre, Alibaba, etc. But when it comes to India, all of the Indian internet companies are trading in India. And India is one of the hardest markets to access. In fact, it's basically impossible. If you're a U.S. retail investor, you are 99.999% certain that you are not able to buy stocks on the Indian stock exchanges, which is where the Indian internet stocks trade. So your only real option is through an exchange traded fund. And there's, probably 15 Indian exchange traded products on US exchanges. iShares, of course, has a big traditional index strategy, and that usually is where most of the investors go. But the problem with the traditional indexes in emerging markets is they're full of all these government-owned banks and oil companies and the legacy economy and the family conglomerates that operate like Chable. So I think if you're going to invest in India, you should invest in the Indian internet sector, and our INQQ index is the way to track it, and it owns all of the publicly traded internet companies in India, and that's there is actually one that trades in the United States called Make My Trip, MMYT, which is the only Indian internet stock here, and that's like the leading travel app. So hotels, train tickets, plane tickets, you're going to use Make My Trip. Food delivery, Zomato is one of our biggest holdings in INQQ, which is the DoorDash of India. But maybe let me talk about that company as an example of a couple of important parts of the story, mainly about how early this is in India. So Zomato, which is spelled like tomato with a Z at the beginning, Zomato. Zomato is the DoorDash of India. It is about 60% market share in food delivery. However, as I alluded earlier, sometimes the translation isn't exactly the same. And so you can call it the DoorDash of India, but when DoorDash arrived in the United States, we had a very well-developed restaurant industry. We had no shortage of restaurants at all. And furthermore, the restaurants had plenty of companies that were supplying them what they needed. Sysco, SYSCO, which most people are familiar with, the green trucks that double park in the morning and unload the tomato sauce. So the whole restaurant industry was very well developed. Well, in India, it's all brand new in a lot of ways. And so it's green fields in every direction. So let me give you an example. Yes, Zomato is the leading food delivery company, if you want something from a restaurant. A year and a half ago, I would have told you that the fastest growing and most exciting part of Zomato wasn't food delivery. It was selling restaurant supplies like Sysco, Hyperpure, their own brand. And they've got this incredible model. They go straight from farm to restaurant. I mean, it's a whole different and amazing thing that they've built. And it's a booming business. And so that is a huge opportunity. It's not just the food delivery business, but it's the Sysco business as well. Now, it has a third business now. And the third business is almost certainly going to be the biggest. And it's kind of a brand new business concept. It's called quick commerce. And quick commerce is sweeping India at a very quick rate. And so let me just explain what it is. Quick commerce, as it sounds, is very fast delivery of anything you want. It's 10-minute delivery of anything, right? And now there's an asterisk, not anything, but pretty much anything you would want on a daily basis, thousands of items. And here's the way this works. Rather than have a warehouse every 5 or 10 miles, you're going to make a miniature warehouse, a micro warehouse, every half mile or 3/4 of a mile, a dark store. Okay, so it might be right next to a regular store, but it's not open for, consumers to walk in. And so when you download the app and you're going to put in your location, and it's going to know what store is near you, and you go on, and there'll be about up to 10,000 items available, and you will push the button and say, I want a can of beans, and I want a new broom, and I want a jar of jelly, or whatever it might be. And you're going to push the button, and in that dark store, which is going to be about 3,000 square feet, the products are going to be put in a bag in 1 minute and 40 seconds. And then a scooter, a delivery partner, a scooter driver, is going to grab it. And because you're going to be less than a mile away, he will get it to you in less than 10 minutes. And then he'll come back and repeat again. Now, this is absolutely exploding in India. The growth rate is in the triple digits. And the reason this is such a big opportunity is that the retail market in India is the most fragmented in the world. There's in India, 90% of all the consumer spending happens in 13 million mom and pop stores. And I mean 150 items stores, like a window basically with an inventory around. That Kirana store base is it's $550 billion a year. And now, rather than walk down the block and pick one of 150 items, you can push a button and stay where you are, and that item and thousands of other items can be brought right to you. And this, I can't overstate it. This is exploding. The growth rates, the sector is expected to grow 600% in the next 5 years. And that will put it at 40 billion. But again, there's 550 billion in the old way. And this is changing consumer behavior in India. And it's going in directions that weren't even really anticipated. For example, now in some parts of India, you can get a private ambulance from the Blinkit app in 10 minutes. So during the holidays, they'll have gold, small gold coins so that they can optimize the inventory that's there. You can have something printed and brought to you in 10 minutes, right? I mean, they're really doing incredible things with this business model, and they're barely out of the top cities. So there are thousands of cities now where this isn't even available, but even when it gets to the second and third tier cities, it's working. So I'm very bullish on the Indian internet sector, and this quick commerce in particular is quite a revolutionary thing. And the reason we don't have it here is that we're not densely populated enough. I mean, this business model works in dense cities with large populations and low-cost labor, and you need the two-wheeled vehicles that can be, double parked on the side of the road to complete the delivery. New York City could theoretically support this, other than the last 50 yards and the parking and so forth. But in Indian cities and in other emerging market cities, this can really work well. And so that's what I mean. It's early. I mean, you look at per capita spending on groceries in India, it's like $10 a year online. China is 25x that. So India can grow 500% in almost every vertical, and it'll still be early. So I can't emphasize enough the long-term opportunity in India. There's going to be sell-offs. In fact, right now, we've just had a 20% plus correction. So If you're a long-term investor, that I don't make predictions about tops or bottoms or any stock market movements in the near term. But if you're a long-term investor, I think that INQQ and the Indian internet sector is, definitely something to buy and put away and don't look at for 20 years. And
Yeah, and exactly. And this stuff is not necessary. I mean, we're looking at kind of markets as a whole, right? You're not saying, and tied to a country, right? A developing country with a populace that has changing trends and attitude towards their consumption. And whether that is of, again, like just general intellectual property, whether that's of tangible goods and services. It's not just like saying, hey, like in the early aughts, being like, okay, great, we all need to buy Yahoo and Netscape and really be in the internet. It's, again, a whole market that's emerging, not just kind of a general market segment. So, again, I think to your point, again, of saying, hey, yeah, there'll be corrections. Nothing is ever just going to go on a right angle. It's not going to be a 45-degree angle on the graph forever. But if you can get in early enough, I mean, even a 20% market correction, if you've made, 100x, 100% return, I mean, hell, I mean, I think most people would be pretty happy with 80% return. But again, it's a longer term aspect, right? And again, there certainly probably is abilities to have shorter term gains. A gentleman I spoke with last week that was primarily focused on strategic metal investing. Again, there's a lot of short-term investing that can be done through arbitrage and options on different countries' production of different metals and mining aspects. So there certainly are there emerging markets to be, for the short-term gains, absolutely. But I really like the look. And again, my main kind of thesis for investing, again, being a younger individual, is still longer term, right? It's too much like gambling on the front end. But if you can, kind of look at that emerging market aspect and really just say, hey, look, I want to be invested for a long-term period. Again, we really have that ability to create some of those really outsized value plays for your portfolio in that regard.
the miracle
Yeah,
of compounding.
exactly. And I spoke on Monday to primarily a real estate investor group, and they were probably some earlier, again, people earlier on in kind of their investment life cycles. And I was trying to explain the concept of, tax strategy, especially with regard to qualified plans investing in real estate. And I mentioned, I was like, hey, look, has anyone ever played around with a compounding interest calculator? And again, I think one hand went up in the room, and I was like, find a calculator, plug in, and set your effective tax rate to zero, right? And just start with maybe $10,000, put it out for 15 years, and I made people do it, and just their eyelids disappeared, right? The power of compounding interest is wild when you look at it from a
It's a miracle. I mean, I completely endorse what you've done. I mean, that's exactly you. People need to look at it. That I haven't said this in a while, but I used to say every year investment professionals should be required to review the miracle of compounding, because
and it really is a
it's all about buying and holding and staying the course, and it's just simple math. And the longer your sequence of time periods, if you can do it for 20 years, it works a lot better than 10 years.
yeah.
And then it's the higher percentage you can get, right, times the number of years. And I don't know of any place in the world where the opportunity to benefit from the miracle of compounding is available than the Indian internet space today,
Yeah, exactly.
going forward 30 years.
Absolutely. And from the perspective of so many cool things, especially what you can do in this country, especially with and again, shameless plug kind of for what we do on the retirement plan side, but if you can leverage that in some of these investments through retirement plans, again, if you can set your effective tax rate on these things to zero, it really again, your eyelids do start to disappear when you look at those numbers. But again, to cycle back kind of to where we're at and to bring this in for a bit of a landing, the internet, again, is not, it really isn't dead, right? From the perspective of new things that can be done and value that can be created, we've really kind of focused a lot on some interesting aspects of India. Now, from a perspective of things that people should be kind of aware of, is we've really kind of focused on, the benefits and the things that people should really be excited about. But, we always need to temper, especially in investing, temper the expectations and your viewpoint to always look at the opposite side of the equation, right? What's going to be the balance point of this and things that people need to watch out for? Certainly it's impossible to say what consumer trends are going to be in 5 years, in 10 years, right? It says, is this delivery option going to be as awesome as it is right now when maybe we have a pullback as people are like, hey, I miss my mom and pop stores, right? But again, we don't know what's going to happen. But from a higher level, are there things that people need to, again, really look and temper their maybe strategies? Again, we all know that China has a very tight control from a governmental perspective on things like the internet, like just, again, information transmission throughout their country. Are there things that we can kind of look at a high level to say, hey, like, here's some general things that people need to be aware of when it comes to different places that they might want to look to deploy some capital?
Sure. Well, look, there's a lot of risks in the world, and emerging markets are, almost by definition the riskiest. I mean, Russia, for example, was one of the leading emerging markets, and it's been sort of banned from the investment business or the stock market. So, there's definite risk. In the case of India, you've got, I think, key man risk. Modi is incredibly important. In every country, I think that, you have key man risk, and it doesn't matter if they're, a monarchy or communism or democracy. If the leader goes astray, it doesn't really matter how they got there. So,
yeah.
Now, but Modi has been a big part of the Indian story, and he's young and healthy, so younger by 10 years than our president. So, but you never know. There's that risk. You have in India, in particular, you have a history of religious and ethnic tensions and violence. The partition of India by the British into the Muslim Pakistan and Hindi India was, the effects of that are not gone.
Yeah.
You have currency risk, certainly in India. You have climate risk. It's very hot and very polluted sometimes of the year. So you have all of those risks and other ones that are yet to be identified. They need a lot of jobs for the young people. They know that, though, and they're trying to get a lot of manufacturing jobs. So those are and of course now in real time, one of the biggest risks that has everybody on edge is tariffs and trade war types of things. And as we sit here today, I mean, there's so much dust up in the air. We don't know where it's all going to settle, but certainly the emerging markets, China and India in particular, could be affected negatively by the things the current administration is doing. And so might Mexico and other countries as well. And we'd have no idea, because you put a tariff here, that might change something. You put a tariff on Mexico, that might change something with China. So right now it's a very a time when risks are high around the globe, because there's a lot of changes going on.
Yeah. So one thing, and this might be, again, just kind of popped into my mind as far as a risk profile goes, but and if it's a slightly elementary question, I apologize, but I am curious. So again, to look at, you brought up the particular kind of the issue that's happening with Russia on at least the emerging markets. But from the perspective, again, at least, like, let's look at India from this perspective and a comparison. So again, it's a little bit of a walled garden for the retail investor to go into the Indian stock market to just buy individual securities, right? Buy listed companies. So the main exposure that individuals in the United States have, at least, are going to be investing in things like indexes or ETFs, things that have the ability to go in or kind of track those markets. Now, let's say something to the tune of Russia happens. Again, by no means am I hoping that happens. I hope Russia thing didn't happen to begin with, and everything that went into that didn't happen as well. But from a perspective of people holding an asset like that, what is some of the kind of the risk if there is some type of like embargo? Is there just like a zero liquidity event where you might still hold it in paper, but there's nothing that can be done with it? What happens in that instance?
Sure. Well, I mean, this is something that's happened once in my 20 years so far in emerging markets. But yes, there was about 5 Russian internet companies that were actually, some of them were quite profitable and growing fast. And when the Russian invasion happened, all of the stocks were halted and it was made illegal to trade them. And so they essentially were marked to zero.
Mm-hmm.
So we lost all of our money, which I think was about 3% of our portfolio in one day. Now, having said that, we did hold on to the stocks. They're still in the account. They're just priced at zero. And who knows if there's a resolution that maybe they'll pop back to life. But losing all your money, especially in a single stock, is definitely a risk. I think it's highly unlikely that if you owned a diversified portfolio of emerging market internet stocks that you probably won't lose all your money, but it is certainly possible that you can lose money and all of it in certain securities. And in the case of that, can be because a single company has a fraud or other problems, or it could be that there's a geopolitical issue and the United States government basically makes it illegal to trade these securities, as it did in the case of Russia.
Yeah, and again, to my perspective too, I kind of echo that sentiment. It's like what happened, at least with the Russian portion of it, is I'm not gonna say anomaly. There's definitely things you can look at and say like, here's exactly why it happened, but it's not necessarily a commonality, right? It's a very outsized oddity that kind of thing happened. But again, to the point of understanding risk of investing in emerging markets, it's not just someone losing market share or fraud. I mean, that stuff happens in the United States. I mean, like Enron, WorldComs, and that kind of thing happens, right? We're not immune to it. Those things you have to be careful about. And if you owned a bunch of stock in someone that produced asbestos, right? There's things that happen, right, that will drive value to zero or just make something worthless. But at least when understanding the broad picture of when it comes to investing in emerging markets, geopolitical stuff definitely needs to be taken into account, because there's a lot more that can happen to an investor's position than just, again, the things that we're used to of mismanagement, fraud, products kind of going out of favor or just not being utilized anymore. So again, definitely things to understand. And again, those are some risks, at least from my perspective, and maybe correct me if I'm wrong, that are you can't really hedge against too much. You can do all your market analysis and say, hey, look, this internet company is really taking off, to that point, but you can't really control that. So you just need to kind of factor that in and hedging for maybe the amount of money you're deploying in there and how much of your portfolio you want to allocate.
Yes.
Cool. I'm glad I got that one right, because there's been so much fun stuff to learn, at least in our conversation today with this. And the fact that I've gotten to talk about emerging markets twice in 10 days is pretty awesome as well. So with that said, again, we like to package these things into about an hour. So we have about maybe another 9 or 10 minutes to kind of chat. Is there anything that we haven't really kind of touched on that you feel would be a very good kind of good value to individuals listening when it comes to understanding and deploying into emerging markets?
Well, I would say that, first of all, the iShares, Vanguard, the big traditional emerging market approaches, they haven't made anybody money. The last 10 years, they're basically flat. And the problem with them is because they're not growing. There's so many government-owned banks and oil companies, so much of the legacy economy that the 10-year revenue growth for the broad indexes is negative, and so is the earnings growth. And ultimately, investing is really simple. The reason companies have value is because they make profits. They have earnings, and the owners get those earnings. And because of all of the legacy that's represented in the traditional indexes, they haven't grown their revenue, they haven't grown their earnings, and people haven't made any money. So if you're going to invest in emerging markets, I think that you need to be targeted. And I, having done this for 20 years, and the reason I started my business and things like EMQQ is because I am convinced that if you're going to invest in emerging markets, you want to invest in the internet companies, which, by the way, if you look at the United States over the last 20 years, that was the right answer as well. So
yeah. I mean, technology, people have been saying it for as long as technology's been technology, but technology is the way of the future. So again, why not invest in it? Sometimes those little quips that we hear that we get annoyed by can be relatively salient when it comes to creating a investment strategy. Well, I greatly appreciate you taking your time out. It's always a pleasure when we get to have guests on. Not that I don't appreciate any one of my guests, but especially guests of your stature that come on and take a few minutes to come to our lowly podcast to bring some of this great information to the masses. We really do appreciate it. With that said, if there's I know you do a lot of speaking, you do a lot of education out into the general consciousness of the investing world. If people want to learn more, kind of connect into what you're doing, what's the best way for them to look at what you have going on?
Sure. Well, our website for my business is EMQQ Global. So E as in emerging, M as in market, EMQQ. The idea obviously is emerging markets tech, and so EMQQglobal.com. And I'm on LinkedIn as well. So if you're on LinkedIn, by all means, reach out and connect, and would love to meet you.
All right, great. Well, fantastic, Kevin. I really appreciate you being on with us today. This has been another great edition of the Alternative Investing Advantage podcast. As always, I'm Alex Perny. Thanks for joining with us, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.